High-earning medical professionals have been disadvantaged by their own regulatory bodies. A lot of physicians in Ontario are sitting on a trapped cash problem inside their medical professional corporation. The CPSO won't let a holding company be a shareholder, so excess retained earnings pile up inside the PC with no clean way out. The frustration is real and clearly not fair, as other business have CRA's blessing on shifting passive income to a holding company for the preservation of the Lifetime Capital Gains Exemption. So, the latest clever tax structure is a three-step fix. Section 85 rollover to get Holdco onto the share register, intercorporate dividend to move the cash tax free under Section 112, then immediate share redemption to remove Holdco before anyone notices. In and out. Sounds elegant. It's not. It is actually dangerous. CRA doesn't look at transactions in isolation. They look at the series, and this series has an obvious purpose. Strip retained earnings into Holdco without personal tax. That's dividend stripping, and CRA has been litigating these patterns for decades. GAAR is the big threat. The intercorporate dividend deduction under Section 112 exists for real, ongoing corporate group structures, not momentary share ownership where Holdco only exists long enough to catch the dividend before redemption. CRA has won GAAR cases on surplus stripping with far more commercial substance than this. The 2023 mandatory disclosure rules broadened what counts as a reportable transaction. This arrangement could trigger reporting obligations, and penalties for not reporting are separate from whether the structure holds up. You're on CRA's radar before anyone challenges the substance. Section 84.1 is also live. When a taxpayer disposes of shares to a non-arm's-length corporation, 84.1 can recharacterize a capital gain as a deemed dividend. The Section 85 rollover into Holdco, followed by redemption, is the textbook pattern, and a T2 showing a big intercorporate dividend hitting a brand new Holdco paired with a same-period share redemption flags on its own. Now here's where it gets worse. A lot of physicians have been told their incorporated practice qualifies for the Lifetime Capital Gains Exemption. In practice, it almost never does. The Qualified Small Business Corporation Asset Test requires 90% of fair market value in active business assets at disposition, 50% over the preceding 24 months. Retained earnings parked as passive investments, GICs, mutual funds, portfolio holdings, all count against that threshold. The very cash everyone is trying to extract is the same cash-poisoning LCGE qualification while it sits there. If the extraction only gets part of the surplus out, the MPC still blows the asset test. The physician took on the GAAR risk, the CPSO risk, the 84.1 exposure, and the LCGE still isn't available. Bad trade. Then comes the exit. The buyer pool is tiny. CPSO rules mean only another licensed Ontario physician can buy shares. Constrained market, compressed value, buyer has all the leverage. That buyer doesn't want the passive investment portfolio. They want the practice, the patients, the billing history, the staff. So passive assets come out before closing, meaning the physician pays personal tax on accumulated earnings at exactly the worst time. Because of this, the deal almost always ends up as an asset purchase. The LCGE doesn't apply to asset sales at all. The entire capital gains exemption conversation was academic from the start. Now the physician has a corporation full of cash and no active business. Dividends at personal rates, or Section 88 triggering deemed dividends. The tax deferred for decades comes due at the highest marginal rate, frequently larger than if the physician had extracted incrementally along the way. If the physician dies before fully extracting the surplus, the deemed disposition under subsection 75 triggers a capital gain at fair market value. The estate gets a tax bill, and extracting from the corporation to cover it triggers more tax. Cascading problem that eats into a career's worth of value. A spousal rollover under 76 just kicks the can down the road. The three-step dividend stripping play pokes CPSO bear on the regulatory side, waves a flag at CRA on the compliance side, and the LCGE problem can't be solved by extraction alone because the asset test, the tiny buyer pool, and the reality that almost every physician exit is an asset sale all work against it. The trapped cash problem is real. The frustration is legitimate. But there are compliance structures that solve it. They are boring. They are invisible in front of you. Tax planning that actually works without poking two regulators and hoping neither one notices. Contact a SaferWealth advisor to discuss your situation. SaferWealth.com, it is your money.